Fiserv operates across 3 segments. Acceptance, powered by the Clover merchant platform. Fintech, providing core banking software to 3,000 financial institutions. And payments, processing debit and credit transactions at scale. The company was built through the 2019 First Data acquisition, one of the largest deals in fintech history. 4 numbers define this business. Return on invested capital, 8% in 2025, improving steadily from 2% in 2019, but still below our 15% quality threshold. Revenue has compounded at 13% annually, reaching $21 billion. Net margin 16%. Free cash flow $4.3 billion last year. Phase 1 Forensic Screen. We run 8 accounting quality checks on Fiserv. The result, 4 green flags, 4 yellow and no red flags. Revenue and net income are growing together, no signs of channel stuffing. Free cash flow consistently exceeds net income, with healthy conversion rates. Capital expenditure stays well below depreciation every year. 4 yellow flags to note. Day sales outstanding rose 23%, driven by business mix, not revenue inflation. Adjusted earnings run 58% above GAAP. Acquisition amortization mechanics, not manipulation. Restructuring charges appear every year since the First Data deal, though the trend is improving. ROIC sits at 8%, below our 10% threshold, due to goodwill from the acquisition. Overall verdict pass, the books are clean. Phase 2 Moat assessment, verdict narrow moat. Fiserv's primary competitive advantage is switching costs in its fintech segment. Banks running Fiserv's core banking platform face migration costs of $2 to $150 million, and relationships spanning 15 to 30 years. Bank core churn runs below 5% annually, one of the stickiest customer bases in enterprise software. A secondary source of power is scale economies. Per transaction processing costs decline with volume across hundreds of financial institutions and millions of merchants. Counter-positioning offers a partial advantage. The bundled bank plus merchant ecosystem is difficult for pure-play processors to replicate. What Fiserv does not have: network effects, consumer brand recognition, or demonstrated process power post-acquisition. The biggest threat sits in the acceptance segment. Square, Toast, Stripe, and Adyen are winning new small business merchants with better developer tooling and pricing transparency. If Clover becomes a maintain and milk asset, the First Data acquisition premium destroys value. Overall verdict: narrow moat, durable in core banking over a 10-year horizon, with real risk in merchant acquiring. Phase 3 Financial analysis. Revenue, operating cash flow and free cash flow. Fiserv's revenue doubled from $10.2 billion in 2019 to $21.2 billion in 2025. That's an 11% compound annual growth rate, driven by organic volume growth and the First Data integration. Operating cash flow tracked revenue upward, reaching $6.6 billion in 2024 before normalizing to $6.1 billion. Free cash flow grew from $2 billion to over $5 billion at peak. The business converts revenue to cash at an improving rate, a sign that the integration overhead is fading. Margin trends. 3 margin lines tell the same story. Fiserv's profitability improved dramatically since the First Data acquisition. Gross margin expanded from 48% to nearly 60%, pricing power intact. Operating margin more than doubled, from 16% to 27%. This is operating leverage, revenue scaling faster than overhead costs. Net margin improved from under 9% to 16.4% in 2025. The slight dip in 2025 operating margin from 28.7% to 26.9% is worth monitoring for signs of cost pressure. Phase 4 Capital allocation, verdict yellow. 6 signals, 2 green, 3 yellow, 1 red. The green signals are encouraging. Share count has been reduced by nearly 20% since the post-acquisition peak. The first data acquisition was transformative, and Fiserv has shown discipline since, with no empire building. The red flag is buyback price discipline. The heaviest buybacks, 5.8 and 5.9 billion in 2024 and 2025, were executed at 38 to 40 times earnings. Buying back stock at those multiples, funded by debt, destroys per share value regardless of the count reduction. The three yellow flags: leadership transition risk with the new CEO Shruti Lal, rising debt to equity now at 1.08 times, and a Buffett owner earnings ratio that only works at the current depressed price. Overall, yellow. Strong execution in the past, but the 2024 and 2025 capital allocation vintages are a concern. Phase 5 Competitive Dynamics. Stage, mature, defend and extend. We assess 5 sources of competitive power using the 7 powers framework. Switching costs, yes and strong. Bank core churn is below 5% annually. Migration costs range from $2 to $150 million. This is the heart of the moat, structural lock-in, not behavioral habit. Scale economies present. Per transaction processing costs decline with volume across Fiserv's network. Network effects partial, counter-positioning partial. The Clover ecosystem has some network dynamics, and the bundled bank plus merchant model is hard to replicate. Cost advantages not present. No structural cost leadership versus peers. Durability verdict. The moat holds over a 10-year horizon in core banking. The primary risk is Clover losing share to Square, Toast and Stripe in the SMB merchant segment. If that happens, the counter-positioning angle erodes, but the core banking moat remains intact. Fiserv trades at just 10.6 times earnings, the lowest PE multiple in 7 years, and 2.6 times book value. Our discounted cash flow model places intrinsic value at $71 per share, using a 10% discount rate and a conservative terminal growth assumption. With the stock at $57, that is a 20% discount to intrinsic value. The cash return yield on enterprise value sits at 7.5%, against the current 10-year Treasury yield of 4.5, a positive 3 percentage point spread. The valuation signals opportunity, but the required margin of safety for a narrow moat business is typically 30 to 40%. At $57, we are not there yet. Overall verdict, yellow monitor. Fiserv is a high-quality payment technology business with a genuine, durable moat in bank core processing. Switching costs are structural, not behavioral, locking in 3,000 financial institutions for decades. Revenue has compounded at 11% annually. Free cash flow reached $5 billion at peak. The business is trading at a 20% discount to our intrinsic value estimate of $71 per share. But that discount falls below our required margin of safety for a narrow moat business. 3 things to watch. First, revenue organic growth. Does it recover to 7% or continue slowing? Second, Clover merchant count and revenue per user. Growth engine or declining asset. Third, times interest earned, needs to stabilize above 3.5 times, below 3 is a balance sheet concern. Yellow monitor. Come back when the margin of safety is there or when the business re-rates. Phase 2, the 10-minute test. Result 7 of 9. 9 filters checking whether this is a fundamentally sound business. 6 clean passes. Fiserv trades on NYSE, profitable in all 7 years on record, and operating cash flow has been positive and growing every year. Earnings per share compounded from $1.71 in 2020 to $6.34 in 2025. Free cash flow positive every year, reaching $5.1 billion at its peak. And the share count has fallen nearly 20% since its post-acquisition peak in 2020. 2 yellow flags. Return on equity cleared 10% in only 3 of the last 5 years. Debt to equity has risen from 0.63 to 1.08 times, a trend that needs to stabilize. 1 fail. Integration and restructuring charges in every year since the first data acquisition, 6 consecutive years. This is the only accounting quality flag, and the trend is improving. Overall, 7 of 9. A high-quality business with acquisition scars that are fading. Return on equity, return on invested capital and net margin. ROE has grown from under 3% to 13.5%, driven by improving margins and the effect of buybacks reducing the equity base. ROIC sits at 8% in 2025, improving steadily from 2.1% in 2019, but still below the 10% quality threshold. The drag is the $37 billion in goodwill from the first data acquisition. Strip that out, and underlying ROIC is closer to 35 to 40%. All 3 lines are trending upward. The goodwill ceiling is the key constraint to watch. Shareholder returns share count. Fiserv issued shares to fund the first data acquisition in 2020. The count jumped from 523 million to 683 million. Since then, management has bought back stock consistently every year. By 2025, shares outstanding fell to 549 million, a 19.6% reduction from the peak. The direction is right, the pace is strong. The price paid for those buybacks is the open question. Buybacks versus free cash flow. Fiserv has accelerated capital returns dramatically, from $500 million in 2019 to $5.9 billion in 2025. The concern is the 2024 and 2025 vintages. Buybacks of $5.8 and $5.9 billion exceeded free cash flow in both years. That means the company borrowed to buy back stock. Buying back shares at 38 to 40 times earnings, funded by debt, is capital allocation risk. If the stock is genuinely cheap, it is the right call. At those multiples, the case is not clear-cut. Debt and interest coverage. Debt to equity has risen from 0.63 in 2020 to 1.08 in 2025, a steady increase driven by debt-funded buybacks. Times interest earned peaked at 5 times in 2022 and 2023, and has since declined to 3.8 times. Still above the safety floor of 3 times, but the trend is moving in the wrong direction. This is the balance sheet tension in the Fiserv story. Strong cash generation being offset by aggressive capital returns. If free cash flow growth stalls, this becomes a real concern. Valuation. 2 metrics, price to earnings and enterprise value to free cash flow. The P/E ratio tells a striking story, from 66 times in 2019 to just 10.6 times in 2025. The market re-rated Fiserv sharply as acquisition costs faded and earnings normalized. EV to free cash flow compressed from 39 times to 15 times. At 15 times, you are paying 15 years of current free cash flow for the business. Our DCF base case, $71 per share. Current price around 57. That is a 20% discount to intrinsic value, but below our required margin of safety for a narrow moat business.